Hi, it's Griggs with Obsidian Wisdom. Today we discuss simplifying and streamlining investments for retirement planning. So today we're going to use the case study of David and Emily Turner. They're both close to 60 years old. They plan on retiring within the next 5 years. And one of them has worked as a healthcare administrator. The other one worked in marketing. And they really want to make sure that their investments are aligned with their goal and that they'll be able to accomplish all of the dreams that they have for retirement. This really comes down to one of the three key principles, or at least three key focuses that I find that people have when they're preparing for retirement. Number one is they want to know whether or not they're going to run out of money. Two is they want to optimize their health care. And three, they want to make sure they have long lasting happiness in retirement. When we're talking about whether I run out of money, there are so many ways to really go about this. And today we're going to focus on asset allocation strategies, adapting investment portfolios over time, aligning our investments with our short term and long term goals, and preparing for the transition from accumulation to distribution. Each of these are very important for you to confidently answer the question of whether you'll run out of money in retirement. So right now we're going to focus on your asset allocation strategies. An asset, when we talk about investing for retirement, is normally going to be something that can generate you a return. When it comes to the importance of asset allocation, there's this old 1980s study called the Brinson study, and they concluded that about 90% of your portfolio's performance is based on the asset allocation that you choose. The actively managed funds, timing the market, day trading, things of that nature, that it doesn't really create enough of a bump for the risk that you're taking on. There are other studies that have come along the way that have questioned whether or not that is true, but generally speaking, we go back and forth. Now, whether it's 90, 95% of the success of a particular portfolio, that is a little bit more difficult to discern. But as far as us being able to get the results that we need so that we can successfully retire, almost every study completed has confirmed that asset allocation is a very effective approach to investing. In its simplest terms, asset allocation is just how we divide our money. For most investors, there are probably a dozen or so asset classes. I'll put a chart up where I can at least show you a little bit of them. And depending on whether you're invested in your own personal businesses, real estate, whether that is in the real world or in the market, or you're invested in the stock market, and then inside of the stock market, you could be in large caps, small caps, international markets, emerging markets, bonds. I mean, there really are a lot of different asset classes, but the idea of them is there's a certain amount of risk, a certain amount of volatility inside of each of these asset classes. Also, they perform differently depending on the conditions of the market. So when you are putting together your own asset allocation, the main thing that you want to look at is how soon do I need this money? How much risk am I willing to take? And the type of return that I need. And you'll normally take a look at this and then you'll put together one that works for you based on your own unique circumstances. You'll always hear me say one of the most important parts of financial planning is whether or not I can keep this plan. Because I can put a plan together that works for someone over there, but if your own situation makes it very difficult for you to keep the plan, then there is no benefit to it. And that's why when a lot of people are asking, okay, well, what's the best asset allocation? The truth is, and it's not the sexy answer, is it depends. It depends on your own risk tolerance. How volatile can the market get and you keep your money invested? Are you able to withstand 20, 30, 40% swings? Naturally, how soon you need the money is also very important. If you're going to retire in the next 5 years, then you may be one swing away from losing 20 to 50% of your overall portfolio. But you don't have those extra 5 years to allow your portfolio to continue growing and rebuild those losses. Our losses are never permanent until we have to take the money out, until we have to withdraw it. And that is something that a lot of us forget about when we talk about simplifying and streamlining our investments. Now, I do have another video and I go into great detail about some different asset allocations, some different portfolio designs that you can use. And you can see what the idea is when we talk about the return, the average return, the consistency of the return, and even the percentage likelihood of us losing money over the lifetime of those investments. Because your retirement could be anywhere from 20 to 40 years. And so that means we may spend as much time, if not more time, retired than we did actively working. High level, there are four market conditions that we're generally looking to have a certain amount of investments that perform well in. And when it comes to these four market conditions, we normally find that stocks perform well during times of economic growth, that cash tends to do best during times of a recession, and that gold performs well during times of inflation, and long-term treasuries perform best during times of deflation. So when you are putting your asset classes together, you would be deciding what type of market conditions do I believe we have, and how much risk am I willing to take? If you want a lot of upside because you have enough time before you retire, then it may make more sense for you to be invested in stocks than U.S. treasuries. But if you're closer to retirement and you don't have that much wiggle room, then it may make more sense for you to be invested in income producing assets that have less risk attached to them and less volatility. When you're looking to allocate your assets across these different asset classes, another thing that we often look at is how correlated each of them are. And correlation is a very fancy way of saying, yes, that there are different assets that I can allocate my money towards, but sometimes if these assets are all correlated, then that means that every time the market is going up, every single asset I'm invested in, even though I'm invested in 3 to 4 assets, they all go down together. Or maybe they all go up together because they're all correlated, and that means that they all react to the markets the same way. When you're trying to figure out whether your assets are correlated, there's probably normally 3 to 6 variables that you would look at. There are different formulas and statistical methods that you can use, like the Pearson correlation coefficient or the Spearman rank correlation. Each of these will tell you whether your assets are correlated and how correlated they are. But the reality is that number can vary because it depends on these economic conditions that we're going through. And that would generally be the market cycles where we talked about economic growth versus decline. The second one is geopolitical events. And that's basically saying if I'm invested in one particular country and I may be invested in a variety of assets in that country, but that country goes to war, well, all of those asset classes are going to go down. And so that's the idea of geopolitical events. Economic indicators, things like GDP, inflation, unemployment, monetary policies. What is the government doing? Quantitative easing. Are they printing money? Are they taking money out of the market? And investor sentiment. Just how do the people feel? If I can't convince you that your economy is doing well or poorly, and you're doing the opposite, and what that means is if you live in a country that's in a recession, but everybody's still spending all of the money, then you're not really dealing with a recession. And so I can keep investing in that particular country. And the opposite is also true. If I'm invested in a country or region where everything looks good on paper, but the people feel like they're in a recession, so they're taking money out of the market, they're not spending the money the way that they normally do, well, then it doesn't really matter that everything on paper looks good because when I look at things with my own 2 eyes, it looks like they're all in a recession. And so investor sentiment is this idea that as things get a little bit worse, people invest in these different assets. And if everyone is shifting their money to these assets, even though there's nothing that shows that we're in a recession currently, it's fair to say that if people keep doing that, then it becomes almost a self-fulfilling prophecy and we will actually move into a recession. In times of inflation, some people tend to invest in gold, but you've heard Warren Buffett, he says he would never invest in gold. And so if you're not someone who wants to invest in gold in times of inflation, I've also seen people invest in real estate in times of inflation because generally if everything is going up in prices, that means home values are also going up in prices. You actually just witnessed that in 2021, 2022, where people were paying these high prices for homes because interest rates were low. Everybody had a lot of money. People were getting paid a lot more for new jobs. And because of that, inflation was about 8%. As people had more money and the cost of everything was going up, people were in these bidding wars. And you remember seeing it where people were paying double the price of a house, where a house would be listed for $200,000 and people would pay $400,000 for a house. And you saw how crazy things were getting. That's ultimately why the Fed said, you know what, I'm going to step in here and I'm going to increase interest rates so that way it slows down the housing market. So you tend to see that inflation does move very well with real estate, and that is a great way to hedge your investments for inflation. We'll end this section by discussing strategies for determining your optimal asset allocation. And we talked about it a little bit earlier where it's going to be your risk tolerance, your time horizon, and your overall retirement goals. The goals that you have set for yourself. You guys know I'm a goal-based planner, which is a very fancy way of saying that I need to know what I'm trying to accomplish. And the reason that we focus on goal-based planning is very simple. I've seen enough times to see where if we're focused on the money and the return, that we end up sacrificing things that are very important to us for the money. And then the first thing that we buy when we get our money back is those things that we sacrifice. Where we sacrifice time with our family, and then the first thing that we want to do is pay for a cruise for all of our family to get together. But your family may or may not be interested anymore. Where we weren't taking care of ourselves and we sacrificed our health, and then the first thing that we do when we get our money is we want to buy a personal trainer, a personal chef, a dietitian, and we try to buy back our health. I have found that it just makes more sense to me where we discuss what it is that makes you tick, what are your core values, what's most important to you, and then we can remind each other, hey, this is actually contradicting your core value. I don't think you're going to be enjoying this experience when it's all said and done. You will actually find yourself with a lot of regret. Now, granted, it's your plan. I'm just here to help you do it. So with that said, if you're like, well, Dre, I really do think this is important to me, I think it will work, then I'll say, okay, then we need to update your goals because that's fine. If your goals have changed and that's not as important to you as it used to be, well, that's what goals are for. It's just more of a compass to let us know the direction that we're trying to go. It's not something for us to beat ourselves over the head with. It's not something for us to feel depressed if we don't accomplish it, but it is that compass, that reminder that just allows us to remember what is it that we're doing all this for? Because otherwise, if we forget what we're doing it for, then we end up trading a whole bunch of time for a little bit of money. And I know that that's not something that you want to do. We all want to be able to maximize our time, have the flexibility to choose what we want to do, where we want to do it, with who and where, and all these other things. And when you read books like Happiness by Design, they talk about the idea that our happiness is tied to how much time we spend on our pleasure and our purpose. And if we spend enough time each day on these things, then we're going to be very happy people. If we sacrifice this and the things that we do aren't aligned with our pleasure or our purpose, then we find ourselves that we'll have a bunch of regret and we won't be as happy.